Hi, Alistair.
Hello, Gregor.
It's really nice to meet you. Finally, I've read so much from your work and seen many of your videos, and it's a pleasure to have you here now. Um, and I just wanted to say that I've called the company Gull er penger, which in English means gold is money. So that's the name of the website, and I've been influenced by the company you work for, Goldmoney, which is sort of the same thing. But I guess also the fact that I called the website what I did is because gold actually is money. And to start it off, I would like to ask you about gold as money. We've been without gold for 50 years when Nixon cut the tie to gold in 1971. Could you just walk us through the kind of the history of money, what kind of characteristics money should have, and how we ended up where we are today?
Yeah, sure. I mean, it sort of evolved really out of the fact that it has always been treasured, if you like. And of course, gold is fungible, which means that one piece of gold is exactly the same as another piece of gold, other perhaps than its weight. And so you can allow for the differences in weight. It has been standardized in the form of coins for the last 2,000 years at least. And the interesting thing, this value thing, you find that communities which have had no contact with each other have ended up with exactly the same view on gold. I mean, when the Spaniards discovered the Incas and so on in Central and South America, what did they find? They found that gold was valued there. And I mean, in China has valued gold forever. And the interesting thing is that the Chinese for money is the same word as gold. So it is exactly the same thing. So gold money in China is money or gold, whichever way you want to look at it. I mean, I think the point about gold is that it's nobody's counterparty risk. I mean, in the modern system, we have banks. We have coins which sort of represent gold and silver, but they're not gold and silver at all. There's no gold or silver content in them now at all. There's only that sort of legacy. And this all sort of leads into a basic theory, and that is that people will accept money on the basis that it was money yesterday and the day before and the day before that and the day before that. So that you have, if you've got a history of something being accepted as money, it is more likely to be accepted in exchange for goods today than something that hasn't got that history, that lineage, if you like. Now, obviously, to run around with a set of scales and weigh, gold dust or bits of gold or whatever when you come to exchange things is extremely inconvenient. So, modern economies, even with sound money, really look for gold substitutes. So they'll look for something that is exchangeable for gold. And this happens in sort of two forms. The original gold standard, which was set up by Lord Liverpool and I can't remember, I think Liverpool was really the prime mover. Going back to about 1817, when the new sovereign was introduced, it became a coin standard. Now, what that meant was that you could take a bank's promise to pay, which we now know as a banknote, and submit it to the bank and get gold coin for it. Now that's very, very important, because it means that people are used to understanding that there is a fundamental difference between money, which is gold, and currency, which is a promise to pay, or the counterpart of credit, if you like. And that is a very, very important distinction. So the coin standard, it was a gold coin standard, was set up by, and if you like, administered by the Bank of England, particularly after 1844, when London banks were prohibited from issuing their own banknotes. That then became a monopoly of the Bank of England. The country banks continue to do so, but that, this is perhaps going into too much detail. Now, this is fundamentally different from Britain's attempt to return to the gold standard following the First World War. They set up a commission in the early I think it was in the early 1920s, which eventually led to the reintroduction of a gold standard in 1925, and that failed in 1932. It was a fundamental difference because instead of sovereign coins, the gold standard was a bullion standard. In other words, you could only go in and change your pound notes or let's say money that is owed to you by a bank for a 400-ounce bar of gold. So this was fundamentally different. It removed money, if you like, from the average person. And this is a far less effective differentiation between money and currencies upon which a gold standard must depend. That's a sort of brief overview, if you like, of the situation. Now, we then move on. We had the Bretton Woods Agreement, which was set up just before the Second World War ended. And the idea there basically was that individuals would not be able to exchange currencies for gold. The only people who could exchange currencies for gold were central banks and the sort of, if you like, the multinational organizations like the World Bank, the IMF, and so on and so forth. And they could only do it with the US Treasury. So we then went on to that sort of minimal gold standard, but it gave enough confidence, if you like, in the post-war years for the purchasing power of the dollar to be maintained for a considerable period of time. In the background, there was a bit of shift, if you like, of problems, because initially everybody needed dollars for international trading. So that meant that the demand for dollars continued, despite the fact that you couldn't exchange it for gold. That helped maintain its purchasing power. But America went through a series of wars. First of all, you had the Korean War, and then, more importantly, you had the Vietnam War, which resulted in large quantities of dollars being exported from America and then resurfacing in Indochina, what was, the old Indochina. And this is why France ended up with so many dollars that she didn't want. And what France did under de Gaulle was, and advised by Jacques Rueff, his principal economic advisor, was he exchanged those dollars for gold. And there was therefore a run on the US gold supplies. So the London gold pool was set up to try and sort of get the other central banks in Europe, which had gold reserves, in to help maintain the $35 gold exchange rate. And that was called the London Gold Pool, and that failed in the late 1960s. Now, we don't actually have specific dates for this because all this happened secretly. We're not told. We're not told what's going on. That the information is just not made available to us. But we do know that the gold pool failed in the late 1960s. And that was the run-up to the situation in August 1971, when finally Nixon temporarily, he said, abandoned the gold standard under the Bretton Woods Agreement. And that temporary abandonment is still there. Initially, they raised the gold price from $35 to, I think it was in a couple of steps, to, was it $42, 44, or was it $44, 22, something like that. Anyway, I was completely immaterial. And indeed, the American Fed on its balance sheet has a note of, sort of a promissory note from the US Treasury, which is valued at the official price of gold of $42. I mean, it's just completely crazy. But then central bankers are crazy, as I think people who begin to follow you in Norway will gradually discover. Now, since then, I mean, the first thing that they did, it was very, very important to the Americans to retain confidence in the dollar. Having divorced itself from gold, what they then had to do was they had to deny gold any monetary role whatsoever and say, no, the dollar is king. Gold is now, I mean, later someone called it a pet rock. I can't remember who, but that basically was the approach. The first thing they tried to do was they tried to suppress the price of gold by having a series of auctions. The problem with that was that on one of the auctions, Middle Eastern interest just took the entire lot. And it was because, remember, in the 1970s, sorry, I just have a quick drink of water. In the early 1970s, the price of oil, following the abandonment of the $35 Bretton Woods agreement, the price of oil started taking off. And this actually led, it's a slight diversion here, but it led to an agreement which was struck between President Nixon, the Saudi Arabias, and it was Kissinger was very much involved in setting it up. Yeah. The agreement basically was that Saudi Arabia, as the leading member of OPEC, could charge, it could charge what it wanted in terms of gold. That was recognized by the Americans. But the one thing they insisted on was that the dollars that they well, two things. Firstly, that oil was priced in dollars and not any other currency. And the second thing is that those dollars would, by default, effectively be maintained within the American banking system. Mm. So this led to a change, if you like, in monetary regime from gold being regarded as money to particularly the Arabs and everybody else beginning to accept that the dollar was a viable currency, which was a substitute for money. Mm-hmm. Not really. And it allowed the American banking system to take, if you like, to take all the excess dollars which were being earned by the Saudis through oil sales and recycle them into Latin America. Now, the reason that they were recycled into Latin America was because in those days, I mean, you had the sort of communist, the communists were trying to influence politics in Latin America, South America, and trying to get, if you like, geopolitical control over the region. I mean, remember, it was the time of Che Guevara and obviously Castro in Cuba and so on and so forth. So there was that situation, and the Soviets were trying to capitalize on that. So the way out of this, as far as the Americans were concerned, was basically throw dollars at the problem, just buy all the politicians. And this is what happened to the petrodollars, if you like. They were recycled and then eventually lost effectively. I mean, I remember doing a consultancy job for a consortium bank in London in 1979, and these telexes from Citibank. It was called Citibank in those days, and Citibank would be leading, say, a loan to the Argentinian state for $100 million, and we were asked as a bank to participate in the loan. Now, you couldn't refuse Citibank. You couldn't turn around to the largest bank in the world, which it was then, and say, no, because you get excluded from these lucrative deals, you see. So, every bank literally partook of this. And we knew, I mean, when I looked at what was the purpose of the loan? To further the interests of the state. That was the standard statement, which basically put another way was line the politicians' pockets, which is actually what happened. Most of it basically just disappeared. It didn't It was pure bribery by the Americans to try and retain political control, geopolitical control over the area. So, the dollar has been misused as a currency going way back then. And this was the whole point about breaking any connection with gold. It basically gave the Americans complete freedom to do what they wanted with their own currency.
Yes.
And that is still, and that's still the situation today.
Yeah.
So it's not surprising that from $35, then $42, the gold price today is, I'm looking at my screen, at $17.90. It has reflected, if you like, the debasement of the dollar. And it's reflected it reasonably closely as well. I mean, if you look at the way prices of anything, sort of goods, consumer goods, the price of production, commodity prices, and so on and so forth, you find that there is far more stability when you price them in gold than there is when you price them in a fiat currency.
Exactly.
There have been huge changes. And of course, the other thing is that if you're going to run things with a currency as opposed to money, then you can do things with the statistics to bolster your case. I mean, many years ago, there was we had a prime minister, I think it was about in the 1820s. So I'm going back 2 centuries, Lord Canning. And he came up with a marvelous quote. He said, "I can prove anything with statistics, but not the truth." And that's something that we must bear in mind when we watch, when we observe central banks are doing what economists are doing. I mean, they rely entirely on mathematics and statistics.
Yes.
And they remove the human element, which is really what happens in markets, from their deliberations completely. And not only that, but they amend their statistics to suppress any evidence of humanity in the economy. So this is the world we live in. That is how money has evolved into currencies. And the amazing thing is that, I bring out a pound coin. It looks like a gold coin. I bring out a 10p piece. It looks like silver. I bring out a 2p piece. It looks like copper, but it's none of them. So we still retain this sort of sham that the currency actually is as good as money. It is not.
Yes, but on that, the different kind of the characteristics of money. I didn't even know this way back when I went to the university. I'm not sure if Will learned it, what money is supposed to be. I later discovered it. But could you, before we go back to call it the last 50 years, but could you just describe
what it is,
and what it is not? Yeah.
The money has a central role in what economists call the division of labor. And basically, anyone who does anything specializes. I mean, you can be a carpenter, you can be a builder, you can be an artist, you can be a politician, you can be an economist, you can do, Now, if you are any good at that particular skill, then you will get remunerated for it by people who don't have that skill. Everybody else is doing their own specialist skill. So effectively, you need to have a medium of exchange so that, I work, if you like, as a researcher for Goldmoney. That means that I don't make things. I don't make things which I then have to buy. And I certainly don't grow food. Well, I mean, I've got a few vegetables out there, but I mean, that's not enough to sustain me, particularly in the winter. So I need to go out and buy things. I need to exchange my labor for the goods that I need to satisfy my needs and desires. And we are all exactly the same. So that is the central function of money. Money exists to facilitate the exchange of goods and services. It's as simple as that. Now, other things fall out from that, because if it was just a question of having a medium of exchange, then I could buy something from you on the basis that you accept what I give you as a medium of exchange. Now, you will only do that if you know that you can pass that medium of exchange on to someone else.
Yes.
Yeah. So that is the primary function of it. Another function that falls out of that is that let us assume, and this is going to be true for everybody, that I have concerns about the future. That there are uncertainties about the future. I need to have a reserve of a medium of exchange, which I don't need to use immediately. That is something that I might use, let us say, in a month's time, or 2 months' time, or a year's time. So there then comes out of that another function of the medium exchange, and that is that it must be stable enough in terms of its use value for exchanging goods for me to be confident that it can be used for that function at a stage in the future. And obviously, when you start looking at that aspect of money or currency or whatever it is, the medium of exchange, you then want something which is predictable in terms of its value, is purchasing power, in terms of the goods and services and everything that I desire and need at whatever stage in the future. And we can then take it a bit further. I don't want to work for the whole of my life. I assume there will come a point where I can no longer do what I'm doing because I'm old and infirm. And therefore, I don't want to just die out of starvation at that moment. I need to put something aside so that I can use that as a medium of exchange at some stage in the future. Now, for that very long term, I can probably have assets of one sort or another, which I can realize in the future. But all this depends on a medium of exchange to facilitate these transactions for as long as I live, for as long as you live. So stability in terms of purchasing power of the medium of exchange then becomes paramount. And this is why throughout history, people moved from things like cowrie shells. I mean, they used all sorts of things as a medium of exchange. But the one thing that was generally recognized around the world as being recognizable and incorruptible and divisible, fungible, if you like, in modern parlance, was gold and silver and copper. I mean, we're looking at pure metals. That is still the case today. I mean, we have currencies being debased. Now, I can bring in another aspect of that, and that is that bad money drives out the good. Now, what we mean by that is that, I mean, it goes back to the days when people clipped coins. You know, you'd get a coin and you would just shave a little bit off it and sort of put that to one side and then pass it on. So progressively, when silver coins, I mean, this is when it happened in this country, when silver coins were the medium of exchange, people would steal little bits off it. And so a silver coin would be known as bad money because it wasn't entire. So that was the bad money. Now, when you got a load of silver coins, you go through them and you take out the good ones and you spend the ones which had been clipped. So that was the bad money driving good money out of circulation. And that is the situation really with monetary gold and silver today. They do not circulate as a medium of exchange simply because they are money, and currency, apart from being considerably more efficient and convenient and all the rest of it, debases itself. So I will tend to hoard gold coins. We still have them. We have sovereigns in this country. I will tend to hoard those, and I will spend the money that I earn or the money that I make out of speculating or whatever it might be, because that is currency. That I will spend, but I will hoard gold and silver.
Yeah.
So that, if you like, I hope gives some context as the difference between money and currencies and the basic function of money. And we come back to that. The basic function is to act as a medium of exchange in the process of the division of labor.
Mm. And great, thank you for that. And if we go back to the where we are now, so in 1971, Nixon cut the ties to gold. It's been 50 years since his temporary measure was introduced, if you will. 50 years is a long time. I think I heard somewhere that a monetary system has an average life of 30 to 40 years. I'm not sure if that is correct, but how come we are where we are, and it's kind of no end in sight?
Yeah, I would question the concept that a monetary system has, if you like, a sort of predetermined period of time. I mean, there is. It depends on so many things. I mean, if you read Marco Polo, when he in sort of 1260-ish, 1240, that run by then, went to China, he became an emissary for Kublai Khan, and the Great Khan, as he was known, introduced paper currency, which was mulberry leaves, and he required every merchant to submit gold, silver, and precious jewels in return for these mulberry leaves. Now that didn't last all that long, so I don't know where 50 years comes from. That was not the first experiment with paper money in China. I mean, we've had a sort of coin standard in the UK up until 1914, the outbreak of the First World War, which goes all the way back to, well, certainly to Saxon times. So, the paper money we have is relatively new. And so I don't think you can put a time limit, if you like, on it. Now, in terms of currency, which is the dominant currency in the world and, accepted by everybody, I think that's just an accident, if you like, of geopolitical power rather than something that is predetermined.
Yeah. Good. I have one question about, if we kind of take it a bit further, inflation. And again, what is it? What is it not? We've been taught that inflation is good. We need that. Who benefits from it? Who does not? Could you maybe elaborate a little bit on that?
Sure.
Because it's central to the debasement of the currency.
Yeah. The idea that we benefit from inflation is completely wrong. There are two aspects of this. One is that if you increase the quantity of money in circulation, the users of that money are not initially aware of it. And it provides an apparent stimulus. When you do this as a one-off, it provides an apparent stimulus to the overall economic condition, because you've got this new money that's come in, its purchasing power is additional until it is spent, and the purchasing power of existing currency has adjusted to accommodate it. While it is additional, you suddenly think, oh, hooray, this is good. I mean, we see this particularly with the expansion of bank credit. The Roaring Twenties, which was a wonderful period. I mean, apart from anything else, you had production methods made production more efficient. You had new technology, you had the motor car, you had the telephone, and you had all these wonderful things. You had agricultural equipment, which made farming a lot more productive. I mean, it was great. But what the newly constituted Fed did at the time under Benjamin Strong was it encouraged the expansion of bank credit.
Yeah.
And that expansion of bank credit fueled, if you like, the speculative frenzy which blew off in late 1929 and led into the Wall Street crash, which lasted between around about end September 29 to the middle of 1932. So that's the first thing I would say about monetary inflation. It is, or currency inflation, the inflation of currency and credit. It is a false provider of economic stimulation. And that rapidly ceases when it is that much extra currency is fully absorbed into the economic system. That's the first thing. The second thing, which nobody in government will tell you, is that when a government prints currency, then it gets the benefit of issuing that currency. I mean, you know, let's assume that your government prints a billion kroner out of thin air. Who's getting the benefit? The government is. The government suddenly got another billion to spend because it's printed it out of thin air.
Yeah.
The people who pay for it are you and I, just the ordinary people. And it particularly disadvantages people who receive that money last. Now, the reason for that is something called the Cantillon Effect. This was after an Irish French economist at the time of John Law in France 300 years ago. The Cantillon Effect basically describes how money gets into general circulation. The first time it's spent, because it is completely indistinguishable from existing money, it has the advantage of buying things without prices rising at all. But as it goes into circulation, prices begin to rise. And we can see this. I mean, if you ever come over to London, and which is a big financial centre, it is the centre of the expansion of bank credit in this country. It is the first place that benefits from the expansion of money and credit in the financial system. Okay. You go to London, you find the prices in London are a lot higher than they are anywhere else in the country. Why? Because there's all this extra money. The purchasing power of that money is lower than it is elsewhere. Now, what happens is that money gradually moves out into the wider economy and drives up prices. In other words, it loses its purchasing power as it goes. So who are the real losers? The real losers are the people who are retired, the people who live away from the financial centres, the ordinary people in the country, particularly the poor, the people who have, if you like, no means of benefiting from this. And, you know, governments, when they pay out welfare, they don't adjust the welfare to take account of the loss of purchasing power of the currency. So anyone who's unemployed, people with savings in the banks, I mean, you know, that is being devalued by the loss of purchasing power from the expansion. So to answer your question, there are two fundamental reasons why inflation actually is the most appalling, if you like, crime that government can commit on its people.
Yeah. But we still hear that inflation, it eats away the debt. I mean, that's something we hear all the time.
Well, yes. I mean, if we go back, I mentioned the situation with America following the Second World War. There was, you know, confidence in the purchasing power of the dollar had been retained quite significantly. Now, really what this meant was that over time, the purchasing power of the dollar declined at a lower pace than it would otherwise if we were just looking at the extra dollars put into circulation. The long-term effect of that, with a control on the amount of government spending, the false stimulation of the economy, was to increase the taxes and thereby reduce the outstanding level of debt. The situation today is, however, very, very different. If you look at the future welfare liabilities of a modern socialist state, I mean, in America, it's estimated that on their 20 trillion economy, the future liabilities of welfare and pensions and all the rest of it on the state alone are in the region of $200 trillion.
Yeah.
So you've got to look at the net present value of those future commitments. We didn't really have this problem in the past. We have it now.
Yeah.
And consequently, if you debase the purchasing power of your currency, then you're going to inevitably find that the cost, particularly things like healthcare costs, which you can't control, are going to rise and remove any advantage that you might get from debasing your currency in terms of on the value of existing debt. So, you know, you need to make this distinction between existing debt, which was the situation after the Second World War, and the control of its growth thereafter, and a situation where that debt, that future debt, is totally out of control. That's that, if you like, is why we can't repeat that situation again.
Yeah. Okay. If we go to Norway now for a second, is Norway in a different position than any other country in the world? And just to briefly introduce that question, Norwegians, they save a lot in equities. Real estate is a very popular form of investing. I guess a lot of people have savings in their bank accounts, but those are really the way that we are, like many other countries, forced to save now. Equities and real estate primarily. And then we have the oil fund, or the Norwegian pension fund global, which is one of the largest sovereign wealth funds in the world. Does that make us very different than any other country in the world? We have a government with almost no debt.
Yeah.
And we have the oil fund. How would you comment that? How was your view on the Norwegian situation?
It's interesting. I mean, on the face of it, Norway is in a wonderful position, and the fact that its government doesn't have any debt or has very little debt places it in an extremely good position in the general sense. These are obvious factors. I think what you've got to do is you've got to look forward to the future and ask yourself whether these factors are still going to be there in the future. And I'd make two comments. If you have a pure fiat currency, its value will be undermined if the whole fiat currency system, global fiat currency system, particularly as epitomized in the dollar, if that collapses, your currency is not going to survive it. You're going to need to have some gold. And I think at some stage, I mean, what I would expect to happen under those circumstances is that governments, or rather central banks, will be forced to reintroduce workable gold standards in order to secure stability in their currencies. So the first question you need to ask yourself is that given that rather terrible prospect, I mean, it's something that you should insure against. So have you got insurance against it? Is your central bank prepared for that situation? So I think that's the first question. I think the second question, and this particularly applies to Norway, is that you've got this global move to do without fossil fuels. You depend on fossil fuels. Now, much as we might think that this is a ridiculous proposition, and it is a ridiculous proposition, there's no doubt about that. It's going to cost everybody everything. I mean, it's just crazy. But there is no doubt that we've got this panic on about global warming, and whatever the evidence, I mean, I'm not an expert on it. I'm not going to, come out with any views on it. But what I would say is that on the current global trajectory, all that oil is going to be, if you like, banned from being used one way or the other. And you're going to have to start looking at doing what we all do, putting in heat pumps and lithium batteries and goodness knows what. And so the whole basis of your national wealth is going to be eroded. So what it means is that you have got to try and retain your national wealth while you have got it, against the problem that you're not going to have that income flow coming out of oil in the future. Now, I haven't even referred to the a possibility that your oil reserves might indeed run out. I mean, I'm not qualified to answer that. I just don't know. But what I would do is I would point out that the world is moving away from fossil fuels, rightly or wrongly. And, the second thing is you cannot be insulated from a collapse in fiat currencies elsewhere in the world, and particularly with the dollar.
And okay, so we have the oil fund and we have no gold. So the Norwegian central bank owns no gold, as we discussed before we started. And we're in the same position as Canada, and I think also New Zealand I saw once. Why do central banks buy gold? Why do they hold it? And why is it that, and of course, I can't expect you to know, but Norway is one of the few ones that we don't have any gold. Do you have any comments on that?
Yeah, absolutely. I mean, central bankers do know that one of the advantages of gold is that it's nobody's counterparty risk. So to have gold in your reserves is actually a very sensible thing to do. Interestingly, the countries which are buying gold and adding them to their reserves are essentially in Asia. I mean, China, which actually, I mean, they don't necessarily declare what they're doing, but we know that China has accumulated substantial amounts of gold, which it is not declaring in its reserves. Russia is doing it more openly, but do not be surprised if when the dust settles, we find that Russia has also been accumulating gold off balance sheet, as it were. The Eastern European countries like Poland have been accumulating gold. Even countries like Croatia are beginning to do that. There is a sort of a growing understanding, and this is particularly true in Asian countries, that the dollar is, if you like, a less secure form of currency to hold in your reserves than it was in the past. And we can see that dollar hegemony, in other words, the power with which the Americans use the dollar, that is diminishing all the time. So banks which are concerned about that, I mean, the Reserve Bank of India is another example. They had hardly had any gold at all. But back in, I think it was 2011, 2012, they bought 200 tons off the IMF. Now, the other thing that's interesting is I don't know whether that's been actually ever delivered to India, but it's just sort of on the books somewhere, which may or may not therefore exist. I mean, a lot of these gold reserves are on paper. We just assume that, because a central bank says that it owns X tons of gold, that it actually has X tons of gold. I mean, one thing we found back in the year 2000, up till the year 2000, there was an analyst called Frank Veneroso who did quite a lot of research into central banking activities in the gold leasing market. And he concluded at the time that as much as half of the declared central bank gold was actually out on lease and in effect was being worn as jewelry around Asia.
Wow.
Now, we don't know, we just don't know the truth of the situation. We just don't know. But central banks do understand that gold is important, but there are a number of banks who have bought into this Keynesian thing that gold is history and no longer money, and therefore you can ignore it. Norway is obviously one, and I would think that Norway's confidence, or your government's confidence, has probably been heightened by the enormous oil reserves that you've got and the cash flow that you can generate from that. Canada similarly has enormous natural resources, but I mean, you've got effectively a socialist party who's got no concept of money. We're seeing this also in America now too. And the Americans, as I referred to earlier, they've got the added incentive of not wanting to see any rival to the dollar. So, they will trash gold as much as they possibly can. I'm talking about the establishment, of course. But the interesting thing is that there is now a geopolitical dimension, because if you look at the members of the Shanghai Cooperation Organization, which is a political grouping, originally it was a security grouping, it has become a political and economic grouping, which now is run by China and Russia. They're the principal ringmasters in this. But if you look at all the other states that are involved as members or associate members and so on and so forth, these include Iran, India, Afghanistan, Mongolia, Belarus, and so on. I mean, we're now looking at almost 40% of the world's population in that grouping. Their central banks are accumulating gold, all of them. And as the geopolitical situation moves away from America towards Asia, if you like, the Eurasian continent, and particularly, I mean, we can keep Europe, the EU out of that, as it were. We're finding that, gold is coming back, if you like, as being central to international settlements. I mean, the Russians have to accept dollars for sales of their oil. But what they do, they get rid of them as quickly as they can. They get rid of them two ways. I mean, basically, they sell them for gold. And the second thing is that they're increasingly trading with China. So they're getting Chinese yuan or renminbi, which they hold on to, or they can deploy in the Shanghai Gold Exchange to buy gold. So, not only that, but Russia is a reasonably high producer. I think she's sort of third or fourth largest producer of gold in the world. So you can see that gold is coming back. It is becoming central on some sort of long-term basis to a Eurasian world, which is taking over in geopolitical terms from America. I mean, of that, there can be no doubt. If you just look at the trend of what's going on, the disintegration of society in America in particular, with all this wokeness and so on and so forth, the Biden administration printing money at enormous rates they just run huge budget deficits. It doesn't matter to them. They've got this magic money tree, and so what's the problem? Just print, fund it, just issue more debt. I mean, they got problems with the debt ceiling, but I mean, the debt ceiling has been violated and then sort of shifted, I don't know, since the Second World War, something. It's almost 100 times. I mean, it's a joke. It really is a joke. So the dollar is basically being destroyed, and so gold is coming back. And that is why countries like Norway really should look very, very closely at their reserves and really make a move to increase from zero, by the sound of it. Their gold reserves. I mean, we've got the same problem in this country. We had a socialist prime minister, Gordon Brown, who in 2000 decided to sell 2/3 of this country's gold reserves. He sold it at roughly $250 an ounce. I mean, what an idiot. I mean, on any level, it was stupid, but it was socialist stupidity that did it. It wasn't an understanding of what markets are, what money is, and the difference between money and currency and credit.
Great. I think those were final good words and a good conclusion. I think we can end it there, Alasdair. I really thank you so much. It's been so nice to finally meet you, and I hope to see you again.
Yeah, and let's hope that it's fascinating. You're the first person, as far from my point of view, who's come out of Norway to try and make sense of what is going on in the wider world. So it's been my pleasure.
Good, thank you, and Merry Christmas to you, Alasdair.
Merry Christmas to you too, and everybody in Norway.
Thank you.
Bye.
Bye-bye.